Good afternoon, everyone. Welcome to our webinar for the launch of the Dutch market sizing of the impact investing ecosystem. I'm very happy to have a number of guests today. My name is Lorve Semius. I'm the director of the NAB, let me introduce to you the planning that we have for today. So I will have a very short introduction that will leave time for the latecomers to arrive. Then Andrea, our research intern, who has been one of the key pen holders for this market sizing report, will be presenting the highlights of the report. Afterwards, we have invited the editorial board that reviewed the report, Yvonne Bakum, Marcel Andringa, together with Alessia Gianoncelli from Impact Europe for a panel discussion to have a conversation around the findings of the report. And then this will be followed by a short Q&A with the audience. So if you have any questions during the presentation or during the panel conversation, please put the questions in the Q&A box of the meeting. And then once we'll finish, I'll probably take a minute for closing remarks. So thank you very much, everyone, for joining. Just a quick note that we have muted everyone, so don't be surprised if you have a question later. We can unmute you, and this event will be recorded, so please be aware that your name and potentially picture might be visible. So maybe very briefly about the NAB, for those of you who don't know us, we're the branch organization of impact investors in the Netherlands. We're an independent non-profit organization and have the ambition to be the prime platform supporting the growth, the scaling up and becoming more efficient of impact investing in the Netherlands. We're part of a global network, the GSG Impact, with active sister organizations in 50 countries, representing more than 2,000 impact practitioners worldwide. Can you go to the next slide, please? Yeah, so in the Netherlands, we have a very flourishing community with very diverse members from private equity to pension funds, insurance companies, asset managers, foundations, specialized impact managers in the Netherlands, in Europe, in emerging markets. So very diverse, and I want to thank actually most of them who have participated in the survey to help us assess the side of the market. So without further ado, I'm going to pass the word to Andrea, who will present to you the highlights of our market sizing.
Yeah. Thank you, Laure, for the introduction, and good afternoon, everyone. I will now guide you through our main results for the 2025 market sizing. So starting with the main trends, what we are seeing in the sector is that investors are starting to shift from asking why to do impact investing to how to implement impact investing strategies next to traditional financial strategies. This is also among the reasons why the Netherlands are a global center for impact finance and among leaders globally in impact investments. We can also see that from a number standpoint, we have impact investments accounting for 52 billion by year end of 2023, while SDIs, which are sustainable development investments, accounted for 151 billion at the end of 2023. Together, these figures account for 7 to 8% of all Dutch assets under management. In the previous market sizing, we decided to have the figures together, but we took a conservative stance this time for the difficulties in basically deciding and classifying an exact quantity of SDIs that can be considered as impact investments. One last trend that is particularly significant is also the growth of impact investments in listed assets, which have always been perceived as challenging, but is a growing trend in the last 3 years. In terms of methodology, we conducted a survey and we received 40 answers. Out of the 40 answers, 35 qualified, and the 5 answers that we did not include in our results analysis were mainly because they were not headquartered in the Netherlands or because they were not investors. Another point of difference from the 2022 market sizing, which was based on 2022 number, is that we didn't make an extrapolation of the Dutch assets under management compared to the total Dutch assets under management. So what you will see in the next slides of the totals are basically the assets under management in impact among the respondents to the survey. We will also hope that from a methodological point of view, in the next years, it will be more efficient to classify SDIs as impact investments, also thanks to the new product of the SDI Asset Owner platform, which is the SDI outcome, which will link basically the SDIs to impact outcomes in 2 categories, which are people and avoided emissions. Diving now deeper into the respondents per organization and per organization size, we can see the high degree of institutionality of the impact investment sector. So more than 1/3 of the responding organizations hold more than 10 billion in assets under management, while the other share of answers is equally shared among organizations which hold less than 100 million up to 10 billion assets under management. This is particularly significant because we see a high degree of involvement of the institutional investor sector in impact investments. This is also shown on the graph on the right, where we can see how public investors, institutional asset manager, pension fund, and insurance companies are all among the main founders of impact investing in the Netherlands, along with specialized in impact asset managers. Diving now into the key figures, we see the total growth of impact investments if among respondents. So in 2022, impact investments and SDIs together accounted for 116 billion, which made it for 10% of the total assets under management of the respondents. This figure grew if we were to take impact investments and SDIs together in 2023. Because as we can see, the total will be more than 200 billions, so 203 billions, which is 15% of the total assets under management of the respondents. Here we can see the growth by percentage of the different type of asset classes. So impact investments strictly grew from 41 billion to 52 billion, which is an average of 20%, while SDIs grew for more than double and are now accounting for 150 billion. If in 2022, based on 2020 figures number, the total impact investments were 4 to 6 of the total assets under management in the Netherlands, SDIs and impact investments now account for 7 to 8%, as I previously outlined in 2023. Another important feature of our survey was trying to understand how many organizations set a target for impact investments. We can see how the vast majority of the investors formulated a target allocation, and 83% is a very consistent number. This also shows how both institutional investors and non-institutional investors are starting to implement impact strategies along traditional financial strategies. On top of this, we can also see how in 2024, institutional players, insurance companies like Achmea, ASR, and VGZ committed to the 10% target that we also launched in 2024. And in terms of distribution and allocation of impact capital, we can see here how out of the 52 billion, in impact investment. 50 billions were invested in listed strategies. This is a very significant chunk of the total, and this is mainly due to institutional investor involvement in this type of strategies. In fact, only one non-institutional investor invested in listed strategies, while, as expected, most of the chunk of impact investments, above 70%, was pursued in private market strategies. And finally, this is due also to the additionality challenge. So we know that for listed markets is more difficult to prove both non-financial and financial additionality. But we are still seeing this trend growing and growing more in the last 3 years. From a regional focus point of view, these results are also in line with our expectation. So we see how institutional and non-institutional investors have similar allocation for what concerns Latin America, and Caribbean, and Asia. But institutional investors have a very significant portion of impact investments among Europe and North America, while non-institutional investors also have a big proportion of their impact investments in the African continent. For what concerns also the SDGs targeted by investors, we see that the top 3 of SDGs targeted is very similar between institutional and non-institutional investors. So the most targeted SDGs for both categories are the energy transition, climate action, and decent work, and economic growth. While institutional investors invest consistently also in health and circular economy, non-institutional investors also have allocations for reducing inequalities, fighting poverty, and gender equality. Historically, there is a set of least targeted SDGs, among which we can find education, peace and justice, and partnership in goals. These are historically underinvested SDGs, and among those we also have SDG 14 and 15, which represent biodiversity, both on land and underwater. We see that the trend, especially from 2024, is an increased interest, both from institutional investors and non-institutional investors in this theme, but this was not represented in our analysis because the numbers were, again, by the end of 2023. Finally, we would also like to highlight the intentionality and the measurement, which are key pillars of impact investing. The most used framework among respondents is the theory of change, followed by the PRI. The PRI are usually used in combination with other type of frameworks, and in general, the trend is that there is still a lot of harmonization that needs to be done, because organizations are still trying to tailor impact frameworks to their own organization by combining different type of frameworks that we can see along the sector. And this is also shown in the column other that you can see on the right side of the graph, which represent basically for most of the organizations we are using an IMM, which is our own. Finally, we would like to leave you outlining the recommendations that we reported in our executive summary and report, which are to adopt the impact of categorizations promoted by the NAB and the European Impact Investing Consortium, which released the paper, the 5 Ws of Impact Investing, at the end of 2024. This categorizes impact investments in impact aligned and impact generating based on additionality of the investors. Also, to report transparently on intended and achieved outcomes, also again for the level and type of additionality as an investor, to issue clear targets for impact allocation, if possible in line with our previously issued 10% target recommendation, to diversify the portfolio for underinvested and underserved sectors and geographies. As NAB, we also have we would like to stimulate investors to consider adopting the NAB's 4% target impact allocation for emerging markets. And finally, to stimulate and collaborate more and more about public and private stakeholders in order to make this sector grow even more than what we grew in the last 3 years, which is very significant and has put this country among the leaders both in Europe and globally for what concerns the impact investment sector. I would like now to pass the word again to Laure and our panelists. Thank you for your attention.
Thank you very much, Andrea, and you kept the timing exactly to the minute. So I'm delighted to welcome our panelists to follow up on the findings of this report. Let me introduce them to you. So I will start with our editorial board, Yvonne, composed of Yvonne Bakkum, who is the chair of the NAB, has been working for many years at FMO, the Dutch Development Bank, and actually in her role was also one of the very early founders of the NAB, so you know us since a very long time, and you also were part of the editorial board of the previous market sizing, Yvonne, which makes you very interesting to compare the findings between the two reports. Then we have Marcel Andringa. You are executive board member at pension fund PME, the first pension fund to join the NAB community, and you are also a NAB board member, Marcel, and we've had a lot of conversations within the editorial board around the methodology. We'll come to that as well. And then I'm also very pleased to welcome Alessia Giannonzelli. She's Director of Knowledge at Impact Europe. And Alessia, you have been working since 2014, if I'm not mistaken, with industry data. The last 4 years, actually, you and I have been working together on trying to harmonize European data collection and surveys. And actually, it's very important to not only to collect data, but also to be able to compare it. So that's why it's so important to have you here as well. So let me maybe kick off immediately with a first question, actually to Yvonne. You have participated in, as in the editorial board of both market sizing. How would you reflect on the evolution of the impact investing ecosystem since the first market sizing? And do you, we state that we think that the Netherlands is a leader, global leader in impact finance. Do you actually agree with this statement?
Thank you, Laura. I think the evolution visible in this market sizing is not only visible in the outcome, but most of all also in the respondents, because I'm really happy that this time we had 1/3 of respondents from the institutional investor side. And that was difficult to get their responses last time. So last time we relied a bit on extrapolation, comparing with some other surveys that had been done among institutionals. But this time I think we can rely more on our own numbers. So that is encouraging and actually fully in line with what I observe in the market and what we have observed also in, for instance, the number of new institutional members to our NAB. So the institutional representation is a very important difference. The growth that Andrea showed so convincingly, of course, the growth of the market, whether or not you take the strict definition of impact investing or include the sustainable development investments, in both cases there is a significant growth, which I think is a great development. Another difference I see is geographies. Compared to last time, we see an increasing attention to Europe, also among non-institutional investors, and a constantly lagging interest to emerging markets. And I think we'll get back to that later.
Yeah, that's right. Thank you very much, Yvonne. So maybe coming back on the methodology, SDI, Sustainable Development Investments, are investments in SDG-aligned organizations. This was started by a group of pension funds shortly after the release of the Sustainable Development Goals. Marcel, as Executive Director of PME, you are also leading the investment strategy of PME. SDIs are part of your strategy. So how do you see the SDIs? And maybe as a second question, during our conversations in the editorial board, we decided to put the private SDIs, actually, to consider them as impact investing. Can you tell us also what was the rationale behind this decision?
Yes, thank you, Laura. And I think the last question is what you think about the topic at PME. And to be honest, at the moment, the SDIs are not a real target of PME because we have a target on impact investments. And those impact investments are all in private markets. And the reason why is that we have a very conservative stance on impact investments. And that's because we are a little bit afraid of the risk of greenwashing. And we think that when you speak about impact investments in private markets, we can prove the additionality. And that's more difficult for us in the public markets. However, that has changed because when we set our last target a few years ago, we were not really that aware of the distinction between impact generating investments and impact aligned investments. So I think at the moment we are doing a study to set new targets for 2030. And then for sure we will make a distinction between the two. So, and that's, I think, a very important development to do. Did I answer your question?
You're on
Your
mute.
mic, you're mute.
Sorry. I'm in the area of the NATO, and there are lots of helicopters, even with the doors closed. So thank you very much, Marcel. And indeed, the question of methodology is actually has been a very big pain point for us, not only for us, but actually also at European level. So Alessia, you've been now working since a few years to harmonize, try to harmonize data collection at European level within the European Impact Investing Consortium. So could you tell us a little bit what have been also your key challenges and how you try to solve them?
Thank you so much, Laura. And indeed, as you said at the very beginning, I started being active in this space, collecting data 11 years ago, and now I'm still here, and I'm very much convinced that data should really be something that we use from a practitioner's point of view, us as a network organizations, and also for policy making. So I think that finding a way of harmonizing data collection is extremely important and crucial for European countries. And there are many challenges. As you said, Laura, it's already 4 years that we try to come up with an harmonized way of collecting data. And I think that the reasons why we're keeping this work, and we still believe it's needed, is because on one side we need to have data that we can compare across countries. So as Andrea said, you in the Netherlands, you have a big market. So we have also seen this in the European survey. You are the second market after UK, but we would need really more comparability to make sure that we can say something more in terms of the different actors that are active in your market compared to others. So we need more robust data to really go a bit more in depth into just, okay, saying in terms of asset management, you are there, followed by others. We would need more comparability. I think that with better data, we can also identify where the gaps are in terms of the sector. So we could maybe push for a mobilization of additional resources. So the market would benefit by this at large. And also, I think in terms of policy making influence, we need data, we need accurate data, we need comparable data at EU level to then speak to the European institutions in a consistent way and explaining them what we have observed granularly in the different countries. And maybe one challenge, apart from making sure that we harmonize in terms of timeline, for example, so we all launch the data collection in the same period of time. So we have comparable data looking at the years in terms of comparability of questionnaires. So as we said, asking the same questions, we would also need to find a better alignment in terms of listed assets. Marcel said this. You mentioned that you have collected data also in the Netherlands. I think that we should take a better stand in terms of how we make sure that the additionality component is also rigorous when it comes to listed, because then all European countries can rely on this methodology and we can start really looking into the impact of impact investing into public markets. So lots of challenges, but I think we are getting there. So hopefully in 2026, we will have an harmonized data collection that will really help us achieve what I was just mentioning in terms of the importance of aligning at European level. For the moment, that's it, I think, Laura.
Thank you very much, Alessia, and I couldn't agree more. Maybe coming back on one of the statements of Yvonne, opening statements, that actually the big change compared to the 2022 report is the increased engagement of the institutional sector. Marcel, can I ask you, so you are a pension fund, so what decided you to develop specific investment strategies for impact? What were the triggering elements?
Yeah, I think that you have to go back already a few years. I think it's very important that one trigger in the most important that are participants. And on a regular basis, we do surveys under them. What do they think it's important about the general investment strategy, but also about ESG investing. And then you also come around questions about impact investing. And there I think two things to say about it. One is that what I see in general is that under participants, there is a huge amount of them in favor of investing, of impact investing, as long as it does not hurt the expected return. And I think that in general you can develop strategies that can do that. Another important thing is when we do those surveys and speak, also have conversations with our participants, is to ask them what kind of topic do you think are the most important. And in general, I think at the most pension funds, you see that the energy transition, climate, the last year's biodiversity, circularity are very important themes. For us specific as PME pension funds, we are the pension fund or for a part of the Dutch high-tech market. Our participants answered that they find it very important that we invest in innovation, in technology, in startups and scale-ups in the Netherlands. So that they gave this backers to us already, I think 7-8 years ago. And for us, is that also a very important impact topic to include. So that's the way we work. And every 1.5 year, we do new surveys. And what I see at the moment is that I already mentioned it, that also for participants, investments in biodiversity as an impact team is also becoming very important. Now, the last step is that we do have, of course, as a board of the pension fund, and we do have our responsibilities. And I think our fiduciary duty is also to take into account the things that our members like and want, and also what we see, what's happening in the world, and to take that also into account in our investment policy.
Yeah. Thank you, Marcel. And that's indeed something we've engaged with a lot of institutional investors with the team, and indeed that taking into account what the clients or the participants of the pension fund want. That's one of the biggest stimulants for institutional investors to move towards impact. So one of the things we've seen as well is indeed there are some preferred themes and impact at home. What we call impact at home is very often something that, for example, the participants of the pension funds prefer. But then we see that some regions or some themes can be under invested. Yvonne, in your former position at FMO, you were working with allocations in emerging markets. I think you have experienced the psychological resistance around investing in emerging markets. What can we do about it? Can we break the barrier?
Well, Laura, I think I'm still positive. You have to be positive about it. Emerging markets are always associated with higher risks, which is not totally unjustified, of course. But I think in the minds of investors, the risk perception is still higher than the actual risks. And what we see in recent years is more data becoming available, the GEMS database being a bit more accessible for emerging market loan returns, but also the capital requirements study that we did as a NAB a couple of years ago, which actually showed that the real risk is lower than the perceived risk. But I think also thematic focus has some effect on the emerging market investments lagging behind. As Marcel also said, many institutional investors focus on energy and climate. And climate is a broader concept, of course. You have climate mitigation and climate adaptation. And if you invest in mitigation, the benefits are global. If you invest in adaptation, the benefits are local. And actually, adaptation finance is very underinvested. It's less than 15% of total climate finance, and of private climate finance, it's just a fraction. And I think when there will be more awareness of the need, but also the opportunity to invest in climate adaptation, that will automatically give a shift to emerging markets, because their adaptation has much higher benefits. It's also more urgent. So I hope that will cause a bit of extra attention to emerging markets and also social themes in general. So we have seen a great focus on the environmental themes, but the social themes in general are a bit underinvested. And there also, if you look at impact per euro invested, emerging markets are, of course, your go-to destination.
Yeah, very true. By the way, you make a reference to a report we've published a couple of years ago. We will add it as a follow-up in our follow-up email to all the participants if you're interested. Alessia, can I follow up on actually the last comment of Yvonne, which is more on the social themes, which traditionally have been found sometimes more difficult, maybe because of less returns than in technology or in climate. So how do you see that from a European perspective?
Yes, indeed. I think that what we are really trying to do is to do a push for not forgetting the focus on social. What we have observed also through the data that we have collected is that there is still anyway a mix in terms of SDGs targeted. So climate action was the second one, but then we had economic growth, decent work. So I think we can say that the investors are trying to tackle both. What I think might help is also starting to look at the issues with this sort of lens of intersectionality. So meaning that there are, of course, course, more climate-related issues that have also implications on the social issues. So also trying to push investors to take this, I don't want to call it systemic view, but actually seeing that both themes are interconnected and important to be solved. This might help. I refer back to what Yvonne said, the data. There is this probably idea that if you invest in economic growth, you can on the environmental side you can have more returns, which might not be the case if we are able to collect enough data to also make sure that we present the successes that are on the social side, and then I think it comes together with examples, so data, but also examples, whether it's in Europe, whether it's in emerging markets. So really to drive investors to not forget actually the social components.
Yeah, so you're actually touching an important point that we haven't started to uncover really well to date. That is also benchmarking returns. There's a very strong myth that impacts somehow represent a trade-off in financial terms. And the impact community has been trying to fight that belief for many years, but we need more data to be able to contradict this belief. And of course, you have a whole spectrum of capital where some investors might decide to invest with more additionality and less return, but this is part of their strategy, and for the ones that do not want that, they can also invest and have the same returns as non-impact strategies. But again, we need more data on that, and part of our organizations, the NAB, Impact Europe, the European Impact Investing Consortium, is to try to get more clarity on this. We will take some questions in a couple of minutes, but maybe we could talk about the results of the market sizing for a much longer time. But can I ask each of you if you have a particular reflection on the recommendations that the report has offered? And maybe Andrea, can I ask you to share again the page with our recommendations, to put it on the screen? So we can all see it, and asking Yvonne, would you like to start on the recommendation page, Andrea, if you can? Thank you very much.
Yes, thanks, Laura. And of course, all these recommendations make a lot of sense. For me personally, the recommendation on collaboration stands out. I have embraced this personal motto saying joint impact is the best impact, but I really believe this. There are so many hurdles that can be overcome if you work together, and it's a bit like walking, when you go into unknown territory, you'd rather not walk alone. And that's the same with investing. And for instance, blended finance, it's always quoted as the silver bullet for many problems. But blended finance, by definition, requires collaboration between different investors with different risk appetites. And that, I've been working on blended finance solutions myself, and it only works when you really work together. The NAB community of practice for real estate is a good example, but also Dutch pension funds exploring innovative investments close to home together. So I'm very encouraged by all the great examples of collaboration that I see in the market.
Thank you, Yvonne. I very much support that. Marcel, can I ask you from this list of recommendations if there's anything that stands out for you?
So, yes, of course, and to start it, of course, I think all these recommendations are very important and to consider and to do something about. And I agree with Yvonne that collaboration stands at the middle. For me, to add one thing I think that's important, that's the adoption of the impact categorizations promoted by the NAB and the EYYC. And I think it would be a great step if every investor makes the distinction between impact aligned and impact generation investments. I think that would make the conversations we have much clearer, and it makes it easier to get a new report of the NAB and to get a clearer view on the growth of impact investments in general.
Yeah, we're working in that direction, Marcel. Thank you. Alessia, what would be your key takeaway on the recommendations?
Indeed, I would have said of course, starting with the first one, because I mean, not being part of this harmonization work, I think that being able to come up with this paper where we were explaining actually, where we were including the definition of impact investing, is definitely a major step, because then everyone also, while investing, but also while providing data, can refer to the same framework. So definitely this is needed. And I would say on the collaboration side, I agree with Yvonne and Marcel, and maybe going a step further, also collaboration among networks such as the Dutch NAB, Impact Europe, and all the other GSG NABs, because I think that it's not just investors that should collaborate, but also market building infrastructure organizations. So on track. And if I need to pick a new one, I would probably go to the second one when you say this focus on outcomes, actually, because I think that on one side we are getting better in collecting data on capital flows, on impact strategies, but I think we're still a bit behind when it comes to measuring the actual outcomes that investors are producing, and these, I think, might hinder a bit the legitimacy of the sector as such. So if we could really come up with a strong data collection also when it comes to outcomes of investments, I think, again, the sector will benefit from these largely. Again, once more, it's about data and collecting better data. So over to you, Laura.
Thank you very much, and yeah, fully subscribe to all of your highlights. So maybe let me open now the Q&A part. Thank you very much to our panelists for sharing their remarks. So now looking at the questions that have been asked in the Q&A. So I see, maybe let me take the first one that was from Mark Hutton, asking about the methodology, if it's aligned with the GIN in their annual market sizing survey. So yes, absolutely. We base our analysis on the GIN definition. 90% of all our engagement with the Dutch ecosystem use the GIN definition. So this is really the base of our work. And in the paper that we published in September 24 around basically making the distinction between impact aligned and impact generating, the GIN definition was used as the starting point, but as you probably all know in this webinar, the GIN definition is quite high level, and so the devil is often in the details, and we, using the INP process, with the ABC structure, we try to go a level deeper in the GIN definition. So that's, we're not trying to replace the GIN definition, we're trying to further clarify it and making it more practical. So I could answer this first question. Then there was a second question that was more for Alessia. Would another investment structure help grow the impact market? So Oxford academic Oni Patton mentioned investors want a different investment structure for private markets, for example, in VC, more than the 5 to 7 year usual horizon, to align more with making impact. And it's true that sometimes you require more patient capital. So Alessia, does your research agree with this? And then once Alessia has responded, Marcel, what is your opinion on these longer maturities as a pension fund? But let's maybe start with Alessia.
Yeah, I would say that yes, I think we need now innovative way of structuring deals, because I think that we still see investors having different appetite in terms of impact returns, but also risks. And I think there's a possibility to put everything together in structures that are innovative enough. I mean, Yvonne mentioned blended finance. I think that we are in a moment in which we should test different way of combining interest. So we are also following the work that Oni Patton is doing on innovative finance initiative. So I think that the future is there, trying really to do things not in a traditional way, considering that we are still a bit behind the targets. So if we keep doing things traditionally, probably we will not being able to achieve the change that we really would like to see and do it. So definitely in for any kind of innovative structure to combine different interests.
Thank you. Marcel, what do you think? Do we need a different strategy for impact? Do you need to adjust the way that you practice investments?
In general, for impact investments, I would like a longer time horizon. So yes, that's and the reason why is that I think a lot of investment structures and products still have not a really short time horizon, but also not a very long enough time horizon. And I think that there are some examples that they don't work together. So I think a larger time horizon shouldn't hurt the risk of or the returns of the investments, but could be better for the impact part of it. So I agree.
Yeah, thank you. So we also have a couple of questions regarding Africa, and I'm going to try to summarize them. It's the continent has 18% of world population, only 1% of Dutch investments. So there's obviously a mismatch, and actually, to be a bit provocative, shouldn't we focus more on Africa, and isn't impact at home kind of egocentricity? So anybody wants to take the question? Yvonne or Marcel, what do you think of further investments in Africa?
Yes, I think when you talk about impact investing, we especially on the more traditional finance side, we tend to avoid the notion of morals. You don't want to say let's do impact investing because it's the moral imperative. On the other hand, also problems close to home are real problems. So it just depends on the preference, and I think Marcel's reference to the pension fund participants is a good one. It really depends on the preference of the investor, what impact goals are the most important for that investor. Unfortunately, or maybe fortunately, there is still a level of subjectivity, of course, in these type of decisions. It's a matter of preference. We cannot analyze everything to the greatest detail. If, and I said it before in relation to climate adaptation, the impact per euro, if that would become your guiding ratio, then you don't have to have this discussion of what is ecocentric or not. But that it's not the case, and I think everyone thinking about their own individual private investments will have the same experience. There is a strong element of preference, and if your preference is to invest close to home, then that can also be very effective and very impactful.
Thank you, Yvonne. Marcel, do you want to add anything, or should I take another question?
Yes, a little bit. Personally, I would like to do more investment in Africa, but Yvonne spoke about it. When I look at our surveys under our participants, they favor impact investments more close to Europe and most close at home. So that's the result of those surveys. That's also things we have to do something about, and that's not always bad. But when you look at pension participants, not everyone likes impact investments. There are also groups that don't like it, but they are. When you speak to them, they're more. When you say about the investment more close at home, sometimes you can convince them. And I think that's something also we need to make them ready, I think, maybe for the next step in the coming years, and also investments more abroad.
Yeah. Yes, and if maybe I can add something, Alessia, you already alluded to the interconnectedness of the different themes. And of course, in the end, if you take a global point of view, investing in emerging markets is also for the benefit of the entire world, right? Because it improves global stability, but that is a more systemic view and really quite difficult to prove in impact metrics. I mean, it's not feasible to invest in Africa and link the outcome of that investment, for instance, to reduced migration flows. Although I'm convinced that in the end, that will be a relation that exists. But before you have actually demonstrated it in numbers, it will be years further.
Yeah, thank you. And maybe just to comment, there was another remark that a 4% target for emerging markets, that is the NAB target, is too low. I just want to underline that it's 4% and then to compare to 10% of impact. So it's 40% of the impact target that should be an emerging market, which is very ambitious, and that we are also trying to support by demonstrating to investors and trying to address the perception of risk. So every time we organize an event or make a publication, we always include examples from emerging markets to show that it is possible to invest with financial return and an acceptable degree of risk in emerging markets. But you have to also fight A, mindset and perception, and B, preferences as well. And I think, just as every private investor can tell their bank or asset manager, I would rather put my portfolio in sustainable rather than just mainstream investments. Well, you might have a preference also for themes at home, like we have a housing crisis in the Netherlands, for example. So I can imagine that a lot of pension participants would like to find houses more easily, and that's a more present matter for them personally. Maybe continuing on the questions. So there was a question talking about the distinction between impact aligned and impact generating. If we see a role for the NAB in developing a further distinction between impact investments that target market return and those that are willing or able to accept trade-off between impact and risk-adjusted return. So to answer this question, that's part of our methodology to define the additionality. So impact generating entails an additionality from the investor side. And maybe I should give the word to Alessia actually to explain how this has been decided within the consortium.
Yes, so when it comes to this investor contribution, let's say, so the way in which we can track additionality on the investor side, so the definition of impact generating, we were looking at concessionality as one of the elements, not as the only element. And we were coupling this with having a patient and flexible strategy, and with taking disproportionate risk because you are targeting underserved beneficiaries or sectors or geographies. So definitely we see a variety of financial returns expected, but we believe that we can consider these strategies being equally important when it comes to additionality. And I would like to say that we also consider the non-financial additionality as a very important component when it comes to impact generating. And maybe not to do some promo, Laura, but we are going to have a webinar precisely on that on the 1st of July. So looking at more granular data when it comes to returns and additionality. And the point is really that you can achieve different levels of returns if you still invest with a mindset that is additional because you do other things. So hopefully it was clear enough, but it's definitely an important discussions to have, and data again and cases might help.
Yeah, indeed. So return is one of the possible additionalities that an investor can have. It's by far not the only one. And indeed, if, for example, your foundation and your aim is to be more catalytic in your contribution to the impact, then you can choose to have a lower return. So we will put the link to this webinar that you're having, Alessia, also in the email. And by the way, there was a question in the chat if the presentation will be shared. Yes, the presentation will be shared, and we're taping this webinar, so we will put it on our YouTube channel as well and share it with all of you. There was also a question about, and that will be the last one, the SDIs, the growth. Is it really growth, or is it reclassification as SDIs? So maybe I should actually ask Marcel, because you're our in-house specialist. So SDIs, have you reclassified part of your portfolio in SDIs, or are they really new investments?
I think it's a difficult question for me to answer, Laura, to be honest. That we did not reclassify, but I think I would like to ask the question to Andrea, what he saw in the answers and what he expects what's happening.
From what we saw, the SDIs are new investments. Also, they will meet intentionality requirements of impact investing, and we really saw the growth also for big players and other pension funds that set new impact targets that are also public. So, for example, ABP, and they also increased both impact investments and SDIs targets and allocations. So I believe that a significant part are new investments that were not there before. Even though at the beginning of SDIs, it's also possible that some of them were a reclassification of the portfolio. But for classifying them as impact investments, for example, that would be one of the main discriminants, let's say, because there would not be the intentionality criteria to classify them as such.
Yeah. So on this last note, we are going to conclude. I would like to thank, first of all, Andrea very much and the team for these very long months of preparation and research, and everybody that contributed to preparing this report. Thank you very much. I also really want to thank very much our editorial board, Yvonne and Marcel. You've spent many, many long hours discussing methodology with us. Thank you for your insights. And of course, Alessia, thank you very much also for joining us in this panel today and for the great collaboration on harmonizing definitions. Yeah, maybe just come back one slide. We have some publications. We will share this presentation with you, but the first report is our mapping 3 years ago. The next two are diagnostic studies that were zoom in specifically on the institutional sector and on emerging market investors in the Netherlands. So if you want more granular information, you can find it in these detailed reports. And the last one is the European size of impact investing, published by Impact Europe, that concerns more private markets at European level for now. So it's not really comparable to our report in the Netherlands that has both private and listed, but it is a very good source of information on the state of the market in Europe. And then if we can put the last page, yeah, thank you very much everyone for having joined us. And please join us again to other events. And if you need to get in touch, you have our contact details. Thanks again. Have a nice day.